Good morning, and welcome to AI Daily for Friday, July 24th, 2026. Yesterday, we told you Wall Street shrugged at the best cloud quarter in the history of the business. Today, the shrug turned into a slide. The Nasdaq fell more than 2%, Alphabet lost 7%, Tesla lost 14.5%, and the reason was the same word every time: capex. Then, after the closing bell, Intel posted its fastest revenue growth since 2011. And in Washington, the White House accused a Chinese lab of stealing an American model, and the Treasury Secretary said the word sanctions. One housekeeping note before we start: no new Frontier model shipped in the last 24 hours, so we are skipping models and tech entirely today. Here is everything else. Start with the tape, because Thursday was the day the AI trade stopped shrugging. The Nasdaq Composite closed at 25,137.69, down 2.15%. The S&P 500 fell 1.21% to 7,408.3. Alphabet, the company that 24 hours earlier reported 82% cloud growth, fell 7.13% to $317.69. Tesla fell 14.52% to $319.69. Amazon lost 4.57%, Oracle 4.61%, Meta 3.36%, Microsoft 2.24%. All of those prices come from live market data, and the trigger was not weak demand. It was the cost of meeting it. Alphabet raised its capital spending plan for this year by $15 billion and reported the first quarterly cash burn in its history. For 3 years, Wall Street paid up for growth. On Thursday, it started asking who pays for the growth. Nothing here is investment advice. The second story of the day has nothing to do with earnings and everything to do with power of a different kind. On Wednesday, Michael Kratsios, director of the White House Office of Science and Technology Policy, said publicly, and I am quoting, "We have information that Moonshot AI distilled Anthropic's Fable for the development of its K3 model." He alleged Moonshot built a sophisticated internal platform to run large-scale distillation against United States models, switching between multiple methods of access to avoid detection. He also alleged the company obtained access to export-controlled Nvidia GB300 servers. Treasury Secretary Scott Bessent then warned that Chinese firms could face sanctions if industrial-scale distillation is confirmed. A Chinese embassy spokesperson, Lu Chang, called the accusations entirely unfounded and told Washington to respect the facts and stop smearing China's AI development. The timing is the part to hold on to. Kimi K3's open weights are scheduled to be published on Monday, July 27th. We take that fight apart in the policy section. To the companies. On Wednesday, OpenAI confirmed the largest piece of infrastructure it has ever tried to build itself. It is called Project Camellia, and it is a data center campus in Effingham County, Georgia, near Savannah. OpenAI has secured 3.2 gigawatts of electricity from Georgia Power. Sachin Katti, OpenAI's vice president of compute strategy, said the fully developed project would probably cost more than $30 billion. And that the company is currently searching for partners to help finance and build it. The first several hundred megawatts arrive in 2028. The rest of the build could run all the way to 2032. Notice those dates, because they are the actual news. This is not a product announcement. It is an electricity announcement, and the delivery schedule, not the model architecture, is what sets the ceiling on what anyone can train. OpenAI also committed to pay the full cost of the power and the supporting infrastructure to an independent audit of its environmental commitments, to closed-loop cooling to limit water use, and to cutting its power draw during peak demand. That last list is a direct answer to the 53% of Americans who told pollsters this week they do not want one of these near their home. And a company that spent 5 years being written off just printed its best quarter in 15. Intel reported second quarter revenue of $16.1 billion, up 25% from a year ago. That is its fastest growth rate since 2011, against a consensus of about $14.4 billion. Look at where it came from. Data center and AI revenue rose 59% to $6.3 billion. Intel Foundry rose 31% to $5.8 billion. Client computing and physical AI rose 13% to $8.9 billion. Gross margin on a GAAP basis came in at 40.4%, against 27.5% a year earlier, and operating cash flow was $7 billion. Management said the company has now signed 10 long-term agreements and is supply constrained, meaning data center customers are asking for more silicon than Intel can currently produce. For a business whose entire investment case rested on one question, whether the foundry could ever win real outside customers, 31% growth and a queue of buyers is the first clean answer in years. In products, OpenAI shipped the thing the entire enterprise industry is now converging on. It is called Presence. It launched Wednesday, and it is a platform for deploying AI agents into customer support and internal service desks over both voice and chat. The pitch is not intelligence. It is governance. Presence connects agents to internal systems and company data, enforces policy through guardrails that can interrupt an interaction the moment it moves outside the company's boundaries, tests agents against edge cases and risky scenarios before they ever reach a customer, scores them with simulations and graders, and then uses OpenAI's codex to suggest its own improvements. The proof point OpenAI offered is its own phone line. The company says Presence now resolves 75% of inbound calls on its English language support line with no human involved. Two details tell you where this is heading. First, it is limited general availability, enterprise only, sold through account teams and forward-deployed engineers rather than self-serve. Second, OpenAI is now the fourth heavyweight in this exact market, alongside Google's Gemini Enterprise, Meta's business agent platform, and an Nvidia and ServiceNow partnership. The frontier model race has a sibling now, and it looks a lot more like a services business. Now to policy, and back to that accusation, because the interesting question is what would actually count as proof. Anthropic's earlier claim was specific. It said Moonshot generated more than 3.4 million Claude conversations through fraudulent accounts to extract reasoning, coding, tool use, and computer vision, with metadata linking the activity to senior Moonshot employees. Separately, and independently of the government, Ryan Greenblatt, chief scientist at Redwood Research, ran a cross-entropy comparison of raw text responses across a large set of models and found that Kimi K3 claims to be Claude disproportionately often, roughly 15% of the time on identity prompts, a pattern actual Claude models do not show. That is suggestive. Greenblatt himself listed the innocent explanations: training data scraped from a web now full of Claude transcripts, leftover system prompts, role-play leakage. And here's the hard part. Distillation leaves no fingerprint in the weights. A distilled model's parameters look nothing like the originals. The entire case has to rest on behavioral forensics. Moonshot has not conceded anything, and as of this morning, no court and no agency has made a finding. The same week, the other side of Washington's open-weight fight got organized. On Wednesday, a newly formed group calling itself the Little Tech Association sent letters to President Trump, Commerce Secretary Howard Lutnick, and other officials, urging the administration not to cut American developers off from Chinese open-weight models. Politico reported nearly 200 venture-backed startups behind the effort, with support from Y Combinator and Proton, and signatories including Replit. Their argument, in their own words, American leadership requires two things: world-leading American open-weight models, and continued access for U.S. builders to open models already available worldwide. Suhail Doshi, founder of the AI infrastructure startup Particle, put it less diplomatically. There will be hundreds of companies that instantly die, he said. Pushing the other way, Axios reported this week that OpenAI and Anthropic have aligned in Washington on warning policymakers about the risks of powerful Chinese open-weight models. And David Sachs, an advisor inside the administration, has argued that this kind of scrutiny shades into regulatory capture, entrenching the largest labs by making it harder for anyone else to ship. Same city, same week, opposite letters, and a policy that has not been written yet. And Brussels picked Thursday to remind the largest AI company in the world who else writes rules. The European Commission fined Google €890 million, about $1 billion, for breaching the Digital Markets Act. The split is €460 million over search, where the Commission found Google gave systematic preferential treatment to its own services, naming shopping, hotels, and flights, while demoting competing results, and €430 million over the Play Store, for preventing app developers from steering users toward cheaper offers and alternative payment systems outside Google's ecosystem. In pure financial terms, the number is small. Alphabet reported nearly $120 billion of revenue in a single quarter this week. The timing is not small. It lands while Washington is threatening new tariffs over exactly this kind of European enforcement against American technology companies, which turns a competition ruling into a trade question. To the market board. All prices from live market data, and nothing here is investment advice. Start with why Alphabet fell 7% the day after one of the best quarters any cloud business has ever printed. The company raised its full-year capital expenditure guidance to a range of $195 to $205 billion, up from $180 to $190 billion, a $15 billion increase, and signaled that capex rises again in 2027. Free cash flow for the quarter came in at negative $5.9 billion, the first cash burn in Alphabet's history. Long-term debt nearly doubled to around $98 billion, and the share buyback was suspended. Charu Chinana at Saxo Market said the risk is tilted towards further increases, particularly while Microsoft and others remain capacity constrained. Leila Konayer at eToro added that cloud capacity may look increasingly interchangeable, which could force providers to spend more while accepting lower returns. Put those two quotes together, and you have the entire bear case on the AI build-out in about 30 words. Tesla's 14.5% drop had a different cause and exactly the same shape. Revenue was fine, $28.24 billion, up more than 25% from a year ago. Everything below the revenue line was not. Adjusted earnings came in at 33 cents a share against roughly 54 cents expected. Operating margin collapsed to 1.4% against a consensus near 5.4%. Free cash flow went to negative $1.09 billion, which the company tied to the cost of funding its AI and robotics programs. Electrek reported the slide deepened during the earnings call itself, as Elon Musk repeated robotaxi and Optimus timelines investors have now been hearing for several years, and put the day's lost market value at more than $140 billion. Bloomberg reported that short sellers booked around $4 billion of profit on the move. It is the same story as Alphabet, one rung down the credibility ladder. Spend now, trust me later. On Thursday, fewer people did. Intel is the counterweight to all of that, and it comes with a footnote worth 10 seconds of your time. On the beat itself, $16.1 billion of revenue, 42 cents adjusted against 21 expected, and guidance for the current quarter of $15.8 to $16.8 billion with 38 cents adjusted, both comfortably above consensus. The stock jumped in extended trading. Intel closed the regular session down 2.33% at $100.23, and last traded at $109.15 after hours, up about 8.9%. Now the footnote. On a GAAP basis, Intel reported a net loss of $11 billion, or $2.16 a share. That is not the operating business going backwards. It is a $12.5 billion mark-to-market charge on stock held in escrow from Intel's deal with the United States government. It is non-cash. It is excluded from adjusted earnings, and GAAP operating margin was still positive at 11.1%. Both numbers are real. They are just measuring different things, and you will see both quoted this morning as if they contradict each other. And one more number to carry into the weekend. Nikkei Asia published an investigation this week estimating that 5 American technology giants, Microsoft, Alphabet, Amazon, Meta, and Oracle, are together carrying about $1.65 trillion of off-balance sheet obligations tied to the AI build-out. That figure is larger than the roughly $1.35 trillion of debt those same companies report on their balance sheets. The mechanics are legal and fully compliant with accounting standards. Long-term operating leases on data centers that have not been built yet, bulk GPU supply contracts, joint ventures, and special-purpose vehicles. Nikkei put Meta's off-book exposure near $420 billion, roughly 3 times its reported debt, and Oracle's near $273 billion. The catch is timing. When those data centers actually go live, the leases roll onto the balance sheet. Commentators drew the obvious Enron comparison, and the technical accounting consultant Tom Selling framed the risk about as plainly as it can be framed. The treatment itself is in fashion, he said, but what if one of these companies is a house of cards propping itself up with it? Finally, what to watch? Today, Friday, July 24th, DeepSeek is scheduled to move V4 from preview to stable release, the version that introduces peak and off-peak API pricing, with peak hours charged at twice the off-peak rate. Monday, July 27th, Moonshot is scheduled to publish the open weights for Kimi K3, which is now 4 days after the White House accused the company of building it by distilling an American model. Reporting also points to a White House framework on frontier model access landing before August 1st. And then the earnings wall. Microsoft and Meta report on Thursday, July 30th, Apple and Amazon on Friday, July 31st. After what a single capital expenditure line did to Alphabet stock on Thursday, the number every desk looks for first is no longer revenue, and it is no longer cloud growth. It is capex guidance. That is what we will be reading first. That is AI Daily. That is AI Daily for Friday, July 24th. A market that finally asked who pays for the build-out, a government that accused a rival of stealing the blueprint, and a chipmaker everybody wrote off growing faster than it has since 2011. Notice what was not in this episode, a new frontier model. Nothing shipped in the last 24 hours, so we skipped that section instead of padding it. Every story here is attached to a source you can open, and every price came from live market data. Subscribe, and we will see you tomorrow. Same time, every morning.